Investors seeking stability and income in their portfolios often turn to dividend stocks. In uncertain market conditions, dividend-paying companies provide a reliable stream of income, making them a cornerstone of a well-balanced investment strategy. As we navigate the dynamics of 2024, identifying the right dividend stocks is crucial for long-term wealth growth. Number 10. Verizon Communications Inc. The telecom business looks like it will be one of the nice surprises of 2024. The worst part is over. There is finally light at the end of the tunnel. Verizon has already spent a lot of money on rolling out 5G, and it will spend less on major projects in 2024 and beyond. Verizon has a lot of long-term debt, but if interest rates go down, it will make the payments easier. And bad news from the cable business should finally make those companies act more logically and cut back on spending and pressure on Verizon and other competitors. The company recently said that it was taking a loss on the sales of wireline and wireless equipment in its Verizon business. Number 9. Diageo PLC. Diageo makes some of the most booze in the world. It runs Guinness beer and spirits names like Smirnoff, Don Julio, Johnny Walker, Baileys, and many more. It is based in the UK. A company called Diageo was founded in 1997, but the first Guinness plant opened in 1759. Diageo has a long history of running smoothly. The alcohol business is known for doing well during most economic situations and not going down during recession. People have said bad things about food and drink companies over the past year. Analysts are worried that GLP-1 drugs used to treat diabetes and lose weight could have an effect on alcohol sales. That is a risk, but as far as Diageo shares go, it is probably not that big of a deal. This is especially true for Diageo because it has a huge presence in emerging countries. India, Africa, and Latin America will all be growing economies in the years to come, which will help the company grow. Number 8. JD.com Incorporation. The last few months have been very bad for Chinese stocks, and not just the well-known tech stocks. In Hong Kong, the Hang Seng Index has dropped 44 in the last 5 years and is getting close to levels not seen since 2009. A huge amount of money has been leaving companies that depend on the Chinese economy because investors are afraid that bad things will happen in world politics again. But things are getting worse. Take the well-known online store JD.com as an example. Since their high point in 2021, its shares have dropped more than 75, but the business itself has made a lot more money since then. For example, JD's earnings per share grew by about 17 for the whole year of 2023, and experts predict another double-digit increase in 2024. The stock is worth less than 7 times what it will earn in the next year. It has also started giving dividends, which means that the stock now has a 2.8 dividend yield. Number 7. Hutchison Holdings Limited. Some people are not happy with JD stock because of the bad relationship between the US and China. Many people have also said bad things about Hutchison Holdings, a business company based in Hong Kong. It puts money into infrastructure, shopping, telecommunications, and seaports. It controls 293 berths in 51 ports in 25 countries, which makes the seaport business very interesting. Along the coast, it also makes money from cruise ship ports, river trade, and places to fix ships. A number of the company's other holdings have also done well, and investors have long seen Hutchison as a great way to get into Asia's growing trade and business markets. The slump in that area, however, has caused its stock to drop sharply. Business owners in Hong Kong face real risks in both the political and economic worlds. But this old company has dropped too low on the worries of the moment and is now a great place to make money and grow. Number 6. Bank of America. A lot of people only think of Wells Fargo when they think of the fake account scam. The company's once immaculate image took a big hit, and big investors like Warren Buffett sold their shares in the bank. The bank has had to pay big fines, deal with harsh regulatory actions, and hire a whole new management team led by Charlie Scharf, who used to be CEO of Visa Inc. Scharf has cut costs, taken care of most of the legal issues, and made the business much more profitable. Wells Fargo recently announced earnings for the third quarter that were lower than expected. Wells Fargo also had high severance costs because of recent cuts. But if you take out those one-time things, Wells Fargo's earnings were much better than expected, and the bank did better than many of its competitors in key areas. The bank has also started to raise dividends on a regular basis again, and it is buying back huge amounts of its own stock. Number 5. OneMain Holdings Inc. It is a company that helps people with their money, and they specialize in personal banking. In particular, it gives out personal loans. These can be uninsured or backed by collateral like cars. OneMain has been in business for a long time. It used to be a part of Citigroup before it went public in 2013. It used to work for a big bank for a long time, so it had access to a huge amount of past credit data. The company also did well during financial crises like the 2008 one. As investors worry about a possible recession, its shares are trading at a low price, around 6 times forward profits. Credit indicators have gotten a little worse across the board as things return to normal after a strange couple of years. But because it is very profitable and has been strong in the past, buyers should lock in the nanic dividend yield on its stock while the market is uncertain. Number 4. Duke Power Company. It is time to turn on nuclear power again. It looked like nuclear power was going away after the Fukushima accident. But people are once again interested in nuclear energy because they want to find cheap, dependable, zero-carbon energy. In the past year, uranium prices have gone through the roof, and the business world is buzzing. There is a way for income buyers to profit from this trend, which is good news. It is a major power company in the southern United States. A lot of its energy comes from nuclear power plants. As of now, it runs 11 nuclear power plants in 6 locations in North Carolina and South Carolina. These plants have a total output of 10,700 megawatts. This makes up about half of the energy that Duke gives to people in the Carolinas. Since investors have been doubting the economics of wind and solar investments over the past year, this huge and cheap nuclear power plant is becoming a more valuable asset. Even though the stock has been going up lately, Duke still costs about 16 times expected earnings and has a 4.3 dividend yield. Number 3. Southern Company. Another power company that has a lot to lose from the growing nuclear business is Southern. As the name suggests, the service mostly works in southern states like Georgia and Tennessee. In general, Southern has done better when it has operated in states with good regulatory conditions and generally strong local economies. The company is spending more than $40 billion on its capital investment plan to prioritize clean, carbon-free energy. It is currently undergoing a huge overhaul of its operations. Historically, Southern got as much as 80% of its power from coal. These days, that number is less than 20%. Nuclear has made up a lot of that shortfall. Even though the costs of Southern's nuclear program went up at first, the company has kept going and is now starting to see the benefits as more nuclear units come online. Like Duke, Southern should see its value ratio rise as investors like the mix of generations it has. Moreover, falling interest rates should be good for energy companies because they will have lower interest costs on their debts. Number 2. United Microelectronics Corp. Only Taiwan chip manufacturing and global foundries are bigger than UMC as a chip foundry in the world. Companies that make semiconductors but do not have their own foundries hire others, like TSM or United Microelectronics, to make their chips. Analysts think that semiconductor growth will continue to be strong through the 2020s, thanks to the popularity of AI apps, the Internet of Things, connected cars, and other new ways to use computers. As the overall market grows, it makes sense that the foundry operators like UMC will do better. Concerns about Taiwan's political situation and uneven working results this year have kept United Microelectronics shares down. Tensions between Taiwan and China got worse after the recent elections, which caused more people to sell many Taiwanese stocks. However, buyers may have overreacted. Anyway, UMC stock is now giving back 7.4, which is a pretty good deal for a tech stock. Number 1. Washington Trust Bancorp. It makes sense that investors like big banks for their dividends, and there are some good income stocks in that group. But sometimes, smaller regional banks are safer than the big national banks. Washington Trust Bancorp, based in Rhode Island, was started in 1800 to serve the mills that were opening up along the Pawcatuck River. The local market is very different now, but Washington Trust's business is still going strong. It has been paying dividends for over 100 years and has been able to make more money and keep the payout the same, even during the financial crisis of 2008. Even though the bank has a long history of success, shares have dropped sharply in the last 2 years. It has traditionally gotten a lot of business from underwriting home mortgages. However, when interest rates went up, that business naturally slowed down a lot. Rates are likely to go down again soon, so Washington Trust should make more money in 2024. As of right now, the bank has a 7.7 yield and earns enough to meet its dividend. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.